Okay, hello everyone, welcome back to the channel. So in today's episode, we'll be covering this 4 different things here. First of all is the meta triggering the semi sell-off. Second of all is the jobs market as well as AI disruption. Third of all is the hyperscalers and my thoughts on them right now. And last of all, it's 2 long-term interesting ideas that I have, both of which I've added into Honeywell as well as S&P Global. So let's talk about Meta stock first. So as we all know, on Wednesday, Meta came out and said that they'll be creating some sort of a cloud business, a new cloud business, to sell excess compute. And this led to the narrative of overbuilding as well as overcapacity. So that sort of led to the entire semi sector selling off on Wednesday as well as on Thursday. But I think Zuck is sort of like playing both sides here. It's sending very mixed signals. So on Thursday, he actually came out and said that Meta isn't optimizing for AI yet and that the benefits will come in over the next 4 to 6 months. And if the ROI for that is positive, we could counterintuitively see AI capex increase instead of what the markets are sort of like pricing in today. So I think on Meta's decision to become a neo cloud, it's a slight positive for the company. The issue with the stock today is that the markets don't really understand the use of the capex because they don't have a cloud business. So all the capex currently is being spent on the advertising arm, and the whole debate for this company has been circling around capex. So despite the revenue going up by over 30% in the last quarter, year on year, stock fell after the earnings report because it raised the capex guidance. So in the case of Meta, the capex has been used to number one, drive automated ad creatives, second of all, generations, and third of all, recommendations, etc. So all of this actually don't require a high-end model. So pivoting away towards a cloud business instead of aggressively trying to build best model is a positive for Meta and it protects profitability. But then the question comes back to, why did they increase and spend all this money in the first place if they didn't need it? As for the other hyperscalers, it is a slight negative for them if Meta comes in and has their own cloud business as well. So we saw a lot of your new cloud selling off on the day itself because Meta was formerly a customer of all these different new clouds, and then now they're competing in the same field. So it's a negative because more competition leads to lower margins after all. I mean, yeah, that's what's going to happen if the demand lags. But there's sort of like a balancing act to that as well, which is that token maxing now is unwinding. So if you're looking at all the different companies in the US trying to optimize for token usage right now, they're a bit more cautious with how much is spending on tokens. A lot of the CEOs have actually came out and said that they're spending too much on tokens. Like Uber, I think they've said it, Airbnb, even Meta as well. So this is actually a positive for your hyperscalers because as token prices fall, the economics will shift towards using more compute rather than spending it on tokens and burning it on tokens. And so in summary, this is a positive for your hyperscalers if companies become more aware of their AI token spending and stop token maxing on everything. Basically use the correct models for the correct things to do. Next, let's talk about the jobs market. The jobs market actually came out weaker than expected. So unemployment was down from 4.3 to 4.2%, but the new jobs reported in June was actually a lot lower than what the streets were expecting. So wage jobs data this week suggests a potentially slowing labor market, supporting the rate cut narrative. That's why the markets didn't sell off after the jobs report. So with respect to the jobs market, I think many individuals, they underestimate AI's capabilities. And most small-scale companies, most small-scale enterprises, they're not actively using AI yet, although they already have AI at their disposal. So it's a lot of time that's being wasted and a lot of resources that are being wasted. So my opinion is that there are plenty of entry-level jobs that will be replaced by AI. So those tied to your data entry. Business owners are also actively reducing the need for staff that provide low-value work, such as design, data entry, documentation. And that leads me to these 2 companies here, which is Adobe as well as Intuit, as well as other software companies. I know there are arguments out there that Adobe is cheap, Intuit is cheap. But if you ask professionals working out there, the only case for all these different software companies is if there are issues with compliance. So in the case of Adobe, let's say if a company only allows Adobe products, then that could be a compliance issue. That could be an argument to be made for Adobe. But my view is that a lot of these unregulated, non-essential tasks will eventually be replaced by AI. With work that can be done within minutes, without the need for an actual human and without the need for an actual subscription from Adobe as well as Intuit. Okay, this is some of my thoughts on the markets in general. So I know long-term investing is something that's being pitched online as the holy grail of investing, but my view currently is that you need to have sort of like an amalgamation of the two, which is short-term narratives as well as long-term narratives. So short-term narrative is driven by key debates for the company. So for example, what is the market currently concerned about for an individual company? In the case of Meta, it's the CapEx. In the case of Microsoft, it's the CapEx as well as AI fears. In the case of Google, it's their Google Cloud business and the ROI on that. In the case of Nvidia, for example, is their revenue growth, their GPU sales. So that is the short-term narrative. Long-term narratives are concerned with the market share, barriers, the pricing of the company, as well as the ROIC. So in the case of finding investments and timing it right, I think it comes down to finding an amalgamation between the two, which is your short-term narratives as well as your long-term narratives. You don't want to be caught in a key debate where your stock falls like 50% because of something stupid. Like in the case of Meta, it was up 33% in terms of revenue growth, and yet the stock fell post-earnings report. So the first idea that I have over here is Honeywell. So in the case of Honeywell, I think this is a company that is quite interesting. It just spun off from its parent company, which is Honeywell International. So Honeywell is currently trading at an EV to EBIT of 19.4 times, which is trailing its peers like RTX, like Safran, as well as Schweinstein, despite having strong aftermarket exposure. So aftermarket exposure refers to the recurring revenue that the company receives after selling its initial OE part, which is your aircraft equipment part. So the aerospace industry is currently in a prolonged recovery phase, with pre-COVID recovery that only recently occurred in 2024. So delivery from OEMs are still constrained because of engines. So your engines are the primary bottleneck right now. That's why you're seeing production levels by Airbus as well as Boeing having sort of like a stagnation. So that's the problem for the engines. So airlines have refuted against retiring their fleets early. So airlines right now, they're currently having their fleets for a longer period of time. The age of the fleets are increasing over time, which is positive for a lot of your aircraft OEs with high aftermarket exposure, because your aircrafts that are older, they require more maintenance, and when the duration and the lifespan of the aircraft increases, and then yes, again, you need more reparations. So another thing to note is that commercial air travel has actually recovered post the war. So if you go and track the flights as well as the statistics, basically leading data going into the earnings reports for all these different companies as well as their guidance, I think a lot of them are going to increase guidance because the war actually ended a lot faster than what was expected. So in the case of GE Aerospace, for example, the management actually came out and said that they're projecting for oil prices to remain heightened all the way till end of Q3 towards Q4. And they expect the war to end by then as well. The war has basically sort of ended. A lot of attention is being taken away from there already. The markets are no longer concerned with that. And your Brent crude oil future pricing is now at, I believe, $65. So commercial air travel, look up the statistics, it is recovering. That is a leading indicator that you can have going into the earnings report for a lot of these aerospace companies. So in the case of Honeywell, here are the key debates for the company going into the next few quarters. So the company just spun off from its parent company, and the first key debate is Airbus and Boeing production level. So if production level picks up, then yes, this means more revenue in the case of Honeywell for its OE division, but there could be, there's sort of like a balancing act to that as well. So second of all is actually one of the stronger sort of like key debates for Honeywell, which is the defense spending and confirmation. So Trump actually proposed for $1.5 trillion to be spent on the US defense, primarily to replenish the Iran war munitions, and Honeywell has significant exposure to that segment. So the business has around 40% of its revenue coming in from this defense segment. Third of all is the aftermarket exposure as well as your flight hours growth. That one, you can track it and look for leading indicators going into earnings reports, like what I said earlier. And in the case of Honeywell, I think the management has sent back the expectations for this stock. So if you looked at what they said on their Investors Day, they're projecting for between 6 and 8% sales growth for the company, which suggests sort of like conservatism. So why do I say so? Is because commercial flight hour growth is already around 4%. And if you add on pricing that is above inflation, that gets you already to that 8%. And if you add on a retrofit modification and upgrades growth, which is a double digit, it was 18% last year, the company can easily beat the 6 to 8% that they're projecting in the next few years. So fourth key debate is the standalone cost for the company. This is typically what you will see when companies spin off. You have to hire their new compliance, hire their new staff, hire all this. So the pro forma numbers may be lower than expected or maybe higher than expected. That is what we'll have to see. And last of all is capital allocation post-spin-off. This is what management has been saying and emphasizing on pre-spin-off. So they were saying that spin-off will help to unlock the ability for Honeywell to manage capital better, to allocate capital better, and for the company to invest in growth. So some potential catalysts. First of all is the inclusion in S&P 500, which will drive institutional buying. So this was what we saw in the past few days. Second of all is that the earnings report will beat their conservative projections. And last of all, it's your analyst coverage on this stock. I believe there's only one analyst covering this. It's from RBC. Next, some potential risk. So first of all, it's economic recession. I mean, that one applies for all companies. It's a common thing. So look for leading indicators. And last of all, it's the war. So if the war starts again, then it could be a problem for aerospace companies. Although I think the shock effect is over already. But there are some professionals that think otherwise. They think shock effect isn't being priced in yet. We'll see. Okay. Next company is S&P Global. So S&P Global, it's a very similar picture. So the company has sort of like a short-term narrative as well as a long-term narrative as well. So as we all know, the hyperscalers are spending a lot of money on CapEx. And for them to spend all this money on CapEx, they need to raise debt. And only two companies or three companies that will benefit from this is S&P Global, Moody's, as well as Fitch. So S&P Global will likely be a direct beneficiary of this. And while rates have remained high, our capital markets have remained resilient. So here are some key debates for the company. First of all is that AI fears, of course. So the company post-spin-off will have around 70 to 80% of the EBIT made up of ratings, Platts, as well as indices. So market intelligence is only around 20% of the company's EBIT, and management has actually came out and said, this was from Chris Hohn's meeting, that only 5% is actually subjected to AI threats, which is non-proprietary data. Second of all is the key debate on software. Second of all is the debate on whether or not the company's software ecosystem is weakening. So I think the carving out of their mobility business is the company trying to streamline their business quality to weaken this argument. Third of all is rates. So if rates remain high, then maybe we could see lower capital market activity. Fourth of all is whether or not the company deserves a 7 times lesser multiple than Moody's. So I believe Moody's is trading at 33 times. So is the company really worth 7 times PE lesser than Moody's? That's another argument. And last of all is the company's ability to continually expand its margins. The company increasing margins over time using AI. Management has said and emphasized that they're doing so. So that's the key thing to watch out in the next few quarters. As for potential catalysts for this company, I recently added into it pre the spin-off. So first of all is the spin-off, of course. Second of all is the earnings report, whereby the company comes out and says that they've actually reduced the software contributed EBIT meaningfully post-spin-off and raising the guidance tied to AI debt. So all in all, I think S&P Global is a company that had a potential catalyst, which was the spin-off. We could see further re-rating coming up in the future, conversions to Moody's multiple. So short-term narrative is surrounding the software argument, which is whether or not a company can fend off competition and whether or not the company deserves a 7 times lesser multiple than Moody's. Long-term picture, it's positive. You can't replace ratings at all. So as for the risk, it's economic recession as well as rate hikes. If we see inflation continually being persistent, if we see your AI semiconductor companies continually increasing their pricing, this could have a ripple effect to all of the US economy. That is what we'll have to wait and see. So thank you guys. This is the takeaway this week. Feel free to check out our Substack. It's the link in the description below. We write articles, we cover news every week, and we do deep dives on companies as well. I hope you guys have found this video useful and actionable, and I'll see you soon.